Your credit score isn't a badge of wealth. It's a report card on how obedient you are to a system that makes money every time you stay just a little bit in debt. I'm a Jazz. I have a master's in finance, and I've spent years studying how money really works behind the scenes, not the TikTok version, the banking level version. And the more you understand how credit scoring is actually built, the more you realize it's not designed to measure your freedom. It's designed to measure how profitable you are as a borrower. So in this video, I'm going to pull that system apart for you using two people. Andre, who has an 810 credit score and is secretly broke, and Helen, who has no credit score at all, but quietly has more money than most people in your city. By the end, you'll know exactly why chasing a perfect score can keep you stuck in debt for decades, and how to flip the game so you build wealth first, credit second. Let's start with the world you and I are living in right now. Open your phone and you've probably got at least one app pinging you with, "Your credit score just updated, tap to see." You see YouTube comments where people flex, "Just hit 805, let's go," like they unlock some secret level of life. Banks gamify it with colorful dashboards, green arrows, little confetti animations when your score bumps up by 10 points. It feels like a high score in a video game. But whose game is it? Because here's the uncomfortable truth. A credit score is not a measure of how rich you are. It's not a measure of your IQ, your business skills, or your financial freedom. It is literally a score that predicts how likely you are to use debt, keep using debt, and pay it back in a way that is profitable to lenders. That's it. If you are a perfect, profitable, long-term customer, someone who borrows, pays, borrows again, carries balances, pays interest, uses more products, you are their dream. The score is the tool that ranks you based on that dream. Enter our first character, Andre. Andre has an 810 credit score. On paper, he looks like a financial superhero. Every bank wants him. He's pre-approved for every shiny new card. He gets the best interest rates, the glossy offers, the VIP treatment. Friends ask him, "Bro, how did you get your score so high?" And he proudly shares tips like, "Always pay on time, never miss a payment, keep your utilization low." He feels responsible, he feels smart. But if you actually open Andre's balance sheet, his net worth, a different story shows up. Andre has a nice car on a loan, a big house with a big mortgage and barely any equity. 3 or 4 credit cards that he manages well, but always with a little balance rolling over and a bit of interest being paid every month. Maybe a personal loan he used to remodel the kitchen, and very little in actual investments. Add it all up, and Andre's net worth is negative. If he sold everything and paid off all his debts tomorrow, there would be nothing left. But his credit score is elite. The system loves him because he's deeply integrated into it. Now meet Helen. Helen is the opposite. She hates debt. Years ago, she used credit cards, got into some trouble, and decided she never wants to live that way again. She paid everything off, closed most of her accounts, and today she has 0 credit card debt, no car loan. Rated, she drives an older, fully paid off car, a modest home that she's been steadily paying down, and a $400,000 investment portfolio in index funds, retirement accounts, maybe some rental property. Here's the twist. Helen barely has a credit score, or her score is thin. If she walked into a car dealership, the finance guy's computer might spit out a worse score than Andre's. The algorithm would consider her less attractive because there isn't enough recent active borrowing to judge how profitable she'd be. In other words, the system sees a wealthy, low-debt person and says, we're not sure about you. How does that even make sense? To answer that, you have to understand how the FICO model actually works. Let's break down the 5 big ingredients of your score in plain English. The first and biggest slice is payment history, roughly 35%. Did you pay your debts on time? Late payments, defaults, collections, bankruptcies, they all crush this part, so you're rewarded for consistently paying your bills, but only if those bills are debt. Paying your rent on time for 10 years often doesn't show up. Paying your utilities perfectly, usually invisible, paying a credit card on time, That's gold. The second big slice is amounts owed, or credit utilization, around 30%. This is how much of your available revolving credit you're using. If you have a $10,000 total limit and you're using $8,000, that's 80% utilization. The model hates that. If you're only using $2,000, that's 20%. The model loves that. Notice the subtle trap here. To have a good utilization ratio, the system wants you to have large credit limits and use some of it, but not too much. Translation: stay in the game, keep a card, keep a balance moving, but manage it responsibly. The third slice is length of credit history, around 15%. How long have your accounts been open? How old is your oldest card? What's the average age of all your accounts? The longer you've been in a borrowing relationship, the better your score. So if you pay off a card and close it, over time your average age can drop and your score can dip. The message here: don't leave us. Keep the relationship alive. The last two slices, new credit and credit mix, each about 10%, reward you for having different types of loans: credit cards, car loans, mortgages, maybe a personal loan, and for taking on new credit occasionally without messing up. You are literally being rewarded for having more lines of credit open and active over time. When you put this all together, you see a pattern. The ideal FICO customer is not the person with no debt. It's the person with multiple long-term, well-managed debt relationships. Paying on time, yes, but always in the game. So when I say debt loyalty score, that's what I mean. The system is scoring how loyal you are to the borrowing ecosystem. How consistently you dance, not how quickly you leave the party. If you walk away from debt completely, you slowly vanish from the model. Now you might be thinking, okay, Jazz, but come on, in the real world you need a good credit score to function. Isn't it just smart to play the game? This is where the debate starts. On one side, you've got the score is everything people. Their argument sounds like this: you need a good score to rent an apartment. You need it for a mortgage. You need it for a car. You might even need it for a job in some industries. So you should protect that 3-digit number at all costs, right? On the other side, you have the I want to be debt-free people. Their argument is, I don't want to live my whole life optimizing a system that profits when I borrow. I'd rather have cash, assets, and freedom, even if that means my credit score isn't pretty. So who's right? The real answer is nuanced, and it's where the trap shows up. Let's talk mortgages first, because that's the big one. Most people are told you absolutely must have a strong credit score if you ever want to own a home. And yes, for most mainstream automated lending systems, a higher score gets you better terms. But that does not mean a score is the only way. There is something called manual underwriting. Instead of an algorithm just scanning your score and spitting out an answer, a human underwriter looks at your actual financial life. Your income, your savings, your down payment, your history of paying rent, your bank statements. This is how things used to be done before computers took over. It still exists, especially in certain banks, credit unions, and for specific mortgage types. If you have no credit score but a solid down payment, strong income, and a documented pattern of paying your bills on time, you can get a mortgage with manual underwriting. It's more work. It's slower. It requires more documentation. But it destroys the myth that no score automatically means no house. Now the car myth. Dealerships love buyers like Andre. High score, ready to finance, willing to think in monthly payments instead of total price. They sell him a $40,000 car on a 5-year loan. He pays interest the entire time, and his excellent score helps the dealer's finance department make extra commission. Helen, on the other hand, might walk in with cash or a big down payment and a mediocre or thin score. The computer might not love her. But the car doesn't care. The metal rolls the same no matter your score. If you buy a reliable used car in cash, your credit score is irrelevant. If you save aggressively and pay a car off quickly, your long-term wealth is higher than the person who leased a new car every 3 years just to boost their score. Here's the twist. Truly wealthy people often don't have amazing credit scores. Not because they're irresponsible, but because they don't constantly borrow. They may have no car loans, no revolving credit. They pay for most things outright, and they move homes or investments in ways that confuse the algorithm. From the system's perspective, they're not ideal customers. They're not feeding it enough data. But ask yourself, who would you rather be? Andre, with his 810 score, his payments, his stress, his dependency on the next paycheck. Or Helen, who doesn't impress the algorithm but could retire if she wanted. This is where the trap becomes clear, when you start prioritizing your credit score over your net worth. When you say yes to a store card you don't need for the points. When you keep a small balance on a card because someone told you zero balance might hurt your score. When you delay paying off a loan because you heard keeping it open is good for your credit mix. That's the mindset of someone who is serving the score, not the other way around. So how do you break this without going to the extreme of never touch credit again and making life unnecessarily hard? Here's the framework I want you to use. Build wealth first, credit second. Step 1, get brutally clear on your net worth. Forget your score for a moment. List your assets. Cash, investments, property, businesses, anything you own that has real value. Then list your debts, credit cards, loans, mortgages, money you owe family, everything. Subtract debts from assets. That number is the real scoreboard. That's the number you want to grow. Step 2, prioritize getting out of toxic debt, especially high-interest credit cards. Your goal is not keep a little balance to look active. Your goal is, I don't pay 20 to 30% interest to anybody. Once your high-interest debt is crushed, you can decide whether you keep 1 or 2 no-fee cards open, pay them in full every month, and let that build a decent score passively in the background. But the primary goal is to free your cash to build assets. Step 3, build that emergency fund and start investing. When you have 3 to 6 months of expenses in cash and consistent contributions going into real investments, index funds, retirement accounts, your business, your need to impress lenders drops dramatically. You're less desperate, you negotiate differently, you're not using a credit card as an emergency plan, which is exactly what the system wants. Step 4, use credit strategically, not emotionally. If you want to maintain a solid score for future flexibility, fine. Use one primary credit card for predictable expenses you can pay in full. Groceries, gas, utilities. Set it to auto-pay the full statement balance every month. That way, you're feeding the algorithm enough data to keep your score in good shape, but you're not using debt to float your lifestyle. You're using it as a tool, not a crutch. Step 5. When it comes time for a big purchase like a home, don't be afraid to push outside the automated system. If your score is fine, great, take the good rate and move on. If it's not, but your finances are strong, look for lenders who will consider manual underwriting, local banks, or credit unions willing to look beyond the 3-digit number. Remember, lenders actually want people like Helen. Strong savings, good income, low debt. The computer just doesn't always see it. Sometimes you need a human to look at the full picture. Here's the mental flip I want you to lock in. Your credit score should be a side effect of healthy financial behavior, not the main goal. If you live below your means, avoid high-interest debt, pay your obligations on time, build real assets, your score will usually be good enough for anything that truly matters. And if it isn't, you'll still be in a stronger position than the person who optimized their score but has no wealth. The real trap isn't the existence of credit scores. It's the culture around them. The apps, the ads, the flexing, the I'm better because my number is higher. That culture distracts you from the scoreboard that actually matters. Your freedom, your options, your time, your ability to walk away from a bad job or a bad situation because your money is working for you, not against you. So the next time you get a notification saying, "Congrats, your score just went up 12 points," I want you to ask a different question. Did my net worth go up this month? Did my cash, my investments, my assets increase? Or did I just make a system very happy that I'm still playing its game? If this video helped you see credit scores in a completely different light, here's what to do next. First, hit subscribe because we're going way deeper into the kind of money conversations nobody had with you in school. Second, drop a comment telling me which one you relate to more right now. Andre with the high score and low net worth, or Helen with quiet wealth and almost no score. And finally, share this with that one friend who brags about their 800 but never wants to open a spreadsheet. They might hate you for a minute, but their future self will thank you.